Hello, everyone, and welcome to the latest LPL Market Signals podcast. Jeff Bookbinder here, your host for today, with my friend and colleague, Dr. Quincy Crosby. Quincy, thank you for joining. Looking forward to hearing your thoughts on the Fed and everything else that's going on in the markets. How are you?
I'm fine. Thanks so much for inviting me. Appreciate it.
Of course, of course. So I've been off for a few weeks, so it's good to be back with you. We had our national conference. We took a week off. Then I was on vacation. So thank you to Adam Turnquist and Jeffrey Roach for filling in for me last week. We'll probably hit on some of the same topics that they touched on last week. In fact, I know we will because I listened to their presentation. So here's our agenda for today. Market recap. Of course, the strong market reaction to Jackson Hole was probably the biggest story last week. So we'll talk about that a little more than just about how the market responded, but what it means, what's the outlook for the Fed, rate cuts, and all of that. Then, Quincy, will do your quick hits. So we're going to touch on small caps and the dollar. And of course, it's NVIDIA earnings week. So we'll hit on that as well. That's not the only big news on the calendar. We have core PCE inflation, the Fed's preferred inflation metric, coming on Friday. So that's probably the biggest economic data point of the week. So let's get into it, starting with just the recap. It was a strong week, about 1.5% on the S&P, even better for small caps, which I'll show you here in a minute. So here's the S&P 500 chart. We got really close to the record high from July 16th, about 35 points-ish. And then now pulling back a little bit. Today is Monday, August 26th, 2024, as we're recording this. So we're still only about 1% off of the record high, pretty close, but at the top end of this channel. And so it's going to be, the point here is it's going to be an imposing test, a tough test for the S&P to break out and go higher. The breadth metrics are improving, though. We show here on this chart 28% of stocks at 4-week highs within the S&P 500. That's a nice reading. It's improved nicely recently. And actually, if you look at the percent of stocks above the 50-day, it's even better. It's almost 80%. So we're seeing some pretty good breadth. Here's where I'll bring you in, Quincy. So we had a great week for small caps, right? Up 3.2% on the Russell 2000. So I'm interested in your comments there. And then in general, do you think the market maybe overreacted to Powell? Because, I mean, it's not just a 1.5% week for S&P 500. And look at some of these sectors up more than that. Industrials, real estate, discretionary. I mentioned small caps. Even the international markets did pretty well last week, although there was a US dollar effect. Do you think this market's gone too far?
Well, I think we're going to see a test for the market on the 28th after the market closes, when NVIDIA comes, because that's a major market mover right now, the last year or so. And we're going to hear what they have to say, not just about their earnings, but about the guidance. I think guidance really matters. Even with the pullback, the market is still almost priced for perfection. And NVIDIA is seen as that perfection. And if they come in and miss, it is going to affect the entire market.
Oh, no doubt. You cannot overstate the importance of NVIDIA's results. I agree 100%. So let's move on. I don't want to spend too much time on the recap. I want to get to the meat of the call here. But the bond market was really strong, of course, partly reaction to Jackson Hole and essentially Jay Powell just telling us rate cuts are here. The time to cut is now. Pretty convincing language. So you had about 0.5 point appreciation in the bond market, which certainly helped the stock market. But with this weak dollar, you also had some nice gains in the commodities space. Certainly crude oil has bounced nicely. There's some geopolitics involved in that, but we've had a big bounce in crude oil. And then you see the metals, gold was up almost 1%, silver up 2+. So we're seeing some gains in the metals space, again, responding to the dollar. anything besides just the dollar? We'll get to the dollar in a minute, Quincy, but besides the dollar, is there anything else in terms of commodities or currencies that caught your attention last week?
Well, again, we'll get to the dollar because that is the currency market. But again, the what I saw, which was very interesting, is that as the dollar weakened against other currencies, the dollar was being used, the US dollar was being used as a carry trade currency, because we always talk about the yen carry trade. It's only because the yen was so weak for so long, for 20 years, that it was used. But suddenly the dollar weakened, and reports are coming in that the carry trade carries on, and many of the hedge funds are using the US dollar as that carry trade currency. So I thought that was very interesting. But I think you pointed to it. What was amazing about the market moves was the way that the small and mid caps gained dramatically, because they are above all else interest rate sensitive. And Powell, as you said, was about as clear as you can be in saying you're going to get a rate cut on September 18th. But now what you're seeing is a debate as to whether or not it could be 50 basis points. And obviously much is predicated on the health of the labor market. Chairman Powell basically said that. He talked about inflation. He said it's coming down, but he pointed to the labor market and whether or not it was cooling perhaps a bit too much. So that's why the market is fixated now on the September 6th payroll numbers. But I wanted to add one thing, because you invited me to add something that was different. Did you notice that he said that, yes, the unemployment rate inched higher, but it's still healthy, which it is at 4.3%. It's still a very healthy number. It indicates resiliency in the labor market. However, what he said, because again, what the market is focused on are patterns, and that when those unemployment rates climb higher, they tend to climb higher and then higher. But he said he gave the reason for this, which was, look, we have the labor participation rate increasing and they can't find jobs. The vacancy rate has come down. So therefore, the unemployment rate will climb higher. That characterized something that those who are on the other side of the argument suggest, the ones who are pushing for 50 basis point rate cut, was, hey, there's something more to this than just labor participation rate. And then they pointed to the lack of 818,000 jobs based on the initial Bureau for Labor Statistics benchmark for revisions of how many jobs were actually created from
Yeah,
April
we have a chart
25th.
on that up on the screen now. That 818,000 fewer
Yes,
jobs for the 12-month period, that downward revision was expected, but it was a lot larger, right?
it was some thought it wouldn't be that much, but there were those who thought it'll be over 1 million jobs, and we don't know. We'll get the final number sometime, I believe, in February. But the point is that Powell they said, look, we can't allow the labor market to cool anymore. That's basically what he said. That's why the market is so focused on the September 6th payroll numbers. But he characterized the labor market as being healthy. Well, we understand that, but the argument is, how healthy has it really been if you have anything in the avenue of 818,000 jobs that were not created, actually not created? So this is where now you're getting a discussion amongst analysts as to whether or not the Fed would even consider 50 basis points. Certainly right now in projections, the market is looking at 25 basis points, but the initial unemployment claims on Thursday before we get to September 18th will matter. But certainly the September 6th payroll report is going to be monitored, assessed. Every aspect of it is going to be used to determine what the market thinks the Fed is going to do.
Yeah, we'll get CPI before that.
Yeah.
September 18th Fed meeting as well. So yeah, it's
Yeah.
too early to have conviction. I guess the market's leaning toward 25, not 50.
Except,
But
yeah.
I think the four cuts priced in for the year is even more interesting, frankly, because that implies there's a 50 in there somewhere, right? Do you think we're going to get 100 this year, or is 75 a better guess at this point?
Again, I think it will all depend on the data, and that will be the payroll. The Fed will not hesitate at all. By the way, even up to the election, if they believe that the labor market is deteriorating, their word, at a faster clip, they will come right in and cut rates in between meetings. You know, everyone says, well, it'll scare everyone. I don't think the Fed is going to be thinking about scaring the market. It will be about saving the labor market. And the worry is, are they behind the curve? Well, we're going to find out.
Yeah, they kind of mess it up on the way in. I don't think they want to mess it up again on the way out.
Exactly. They're being very, very careful now.
Yeah,
Mhm.
this next chart. So this is from our weekly market commentary for this week about Jackson Hole and the Fed. And this chart just shows the 2-year Treasury versus Fed funds. And Fed funds effectively aligns with the 2-year, actually vice versa, right? The 2-year Treasury aligns with the Fed funds rate. So I think what this is telling you is, we're going to get a series of cuts. It's, as you suggested, Quincy, it's hard to know how many we're going to get because we're going to see a lot more data before
Oh, yeah.
we
Yeah.
get even 2 cuts, let alone 4, 5, or 6. But no doubt the economy is slowing and a series of cuts is coming. We'll just have to wait and see how far it goes. The debate is around the neutral rate, right? So where will they stop if they decide they want to be neutral? Well, they might get to that point and decide they don't want to be neutral. They might decide they want to be accommodative 6 months, 9 months down the road. So there's a
Oh,
lot of
yeah.
cross currents.
Let me suggest also they may want to hold on to some of those basis points if if the economy slows but inflation kicks up, if consumer inflation kicks up in the fourth quarter. That'll be a quandary for the Fed to have to deal with that.
Sure. We're certainly seeing some asset price inflation right now, that if this market just keeps rallying right on through the old highs, even though the Fed might deny that's part of their formula, they can't completely ignore market appreciation and easing of financial conditions and signs of froth and all of that. So this, I agree with you, Quincy. We don't have enough information to make a high conviction call on where they're going to stop, or even frankly how many cuts they're going to do in the next 6 months. But certainly several cuts are coming. I think we all agree on that. So good conversation. Certainly that will put a cap on how high 10-year yields can go. And we saw last week, right? The 10-year yield dip below 3.8. When you're in a rate cutting campaign, that puts downward pressure on the 10-year, right? It's like an anchor. So that's certainly good for bonds and equities. So let's turn to your quick hits, Quincy. We've got 3 topics for you and 3 charts: the dollar, small caps, and Nvidia. I think the dollar's first. Hopefully I put these in the right order. Yes, I did. So here's the dollar. The dollar's actually down based on the DXY index. I believe 5 out of the last 7 weeks. It's not just about Jackson Hole, right? This has been
Oh, yeah.
going on a while. This is a very long-term chart. I thought it was interesting. There are a lot of fear mongers out there talking about the dollar collapse. So I just wanted to make the point here that since 2008, actually, that's probably not far from when the fear mongering in the dollar began. Basically, the dollar's just gone up. It's just stayed strong year after year after year through the financial crisis, through the mini crises we've had since then, through the pandemic. It's obviously passed a lot of tests. So the dollar's not going anywhere is the bottom line there. Wanted to throw that out. But then just more short term, Quincy, what's driving the dollar? Is it just the interest rate differentials? Is there something else going on here?
No, it's the interest rate differential. I mean, it's behaving the way interest rate differentials behave. I mean, take a look at it. Take a look at it vis-a-vis the euro. We wrote about this morning. will the European Central Bank cut rates in September? When they cut rates before the first time during this cycle, they made it very clear that they weren't going to come in again automatically and don't expect to see a series of rate cuts. Yet there seems to be a convergence on cutting rates at their September meeting. And by the way, the dollar has a role in this because as the US dollar weakens, the euro actually edges higher. And what we know is the exporters, particularly in Germany, are suffering. I mean, the demand is down. There are issues with China, bilateral issues with the European Central Bank and Eurozone with China in terms of tariffs and so on. But overall, besides that, even if we strip away the political aspect, demand is slowing. So a weaker currency will certainly be helpful. And that may be what finally spurs the European Central Bank to cut rates again in their September, I think the date is September 12th, which could very much help, particularly Germany, which is the largest economy in the Eurozone. And by the way, the world's third largest economy, and heavy manufacturing and sluggish. So a weaker euro typically does help, the way a weaker dollar helps our exporters, by the way. And so it is the interest rate differential. Now, needless to say, you can have an event in which everyone flocks to the dollar for strength. And therefore, the dollar, by the way, having all these inflows coming in can affect where the dollar is. But when we watch the way the dollar has eased against other currencies, again, particularly our peers, you can match it up with data. You can match it up with data indicating slowdown, especially in the labor market, especially with regard to manufacturing, for example, or even the time we had the service sector go into contraction, the dollar eased. That is based on pure economics. It's not political. It is based on economics. So right now, I would have to say the dollar easing, softening is a function of, you named it, the interest rate differential.
I guess we're back to good news is good news and bad news is bad news, which is frankly, I think, a better place to be. So we'll root for better labor data because the market's a little bit nervous. The Fed's a little bit nervous about the labor market weakening too much. But the upside to that slowdown that we've seen in recent months, especially just in the last month or so, is Fed rate cuts get priced in and then the dollar gets weak. And that's certainly a better investing environment, not just in general for US investors, but also for US investors in international equities or international fixed income, right? Where you get the currency benefit if you're unhedged. So wanted to throw that in there. So let's go to small caps. And this, I'm in the process of writing up a report on small caps. And so I threw this chart in there that just shows that around the start of Fed rate cutting cycles, small caps don't really do that great relative to large. There's been a lot of excitement about small. I think small caps react more to market rates, like the 5-year Treasury or the 10-year Treasury, than Fed funds. Now, obviously, they're connected, but in this case, maybe we saw the rally either come too soon or be too dramatic because as the Fed gets ready to cut, history tells you that maybe that's not so great. What do you think, Quincy?
Well, normally when the Fed cuts, it is because the economy is not doing well.
Bingo.
That really is it. This is a different scenario, especially if the market sees a rate cut commensurate with inflation coming down. That's what the market wants all along, is that the Fed says, you know what, we don't need these high rates to somehow slow down spending, to slow down the labor market and slow down wages and get prices to start coming down. That's what the market wants, but not a rate cut that is associated with, oh my goodness, we're terrified about the labor market. And that we all know why, because when the labor market starts deteriorating, it can deteriorate at a faster clip we know the relationship with consumer spending is that consumers will really slow down spending. And then hence, we're headed for a recession. That's not what the market wants, but that's normally what happens when the Fed cuts rates. And that's why the small caps tend to be weak for approximately 3 months following the rate cuts. So this time around, the Fed, I think, is what shall I say, is engineering a rate cut because inflation is coming down and it feels comfortable about that. It feels as if the data actually are confirming that inflation is coming down. And we'll see, with the PCE this week, I have to say it, Personal Consumption Expenditures Index, the PCE. If that also suggests that inflation continues to come down, that it hasn't stalled again, and that the Fed is talking about a rate cut for September 18th, I think that may save the small caps, especially if the market believes another rate cut will be forthcoming following the September 18th rate cut. But it is interesting. But let's remember too, small caps sold off brutally with the unwinding of the yen carry trade and all of the, concerns about the US labor market. And so right now they're playing catch up, and they sure did on Friday. That was probably the strongest gains that I've seen in the small cap Russell 2000 space.
Yeah, no doubt. So I think you're spot on. I guess in this place where we are now, maybe a soft landing is more likely than not. But if you look back at history, the market was worried about a hard landing, and most of the time it got, maybe not hard, but it did not get a soft landing. It got a bumpy landing or a hard landing.
Yeah.
And that's where you see, again, so I'm showing relative strength of small versus large 6 months before the cutting cycle, 3 months before, 3 months after, 6 months after. Where you get the best performance, at least in the last 40 years, post 1980, is 01, the coming out of the tech bubble bursting, right? Because what led the tech bubble up, it was large cap tech.
Yeah.
What led the way down when the tech bubble burst? Large cap tech. So small caps and the defensive sectors, non-tech sectors, did very well.
Yeah.
During that aftermath of the tech bubble, of course, large caps did not. This is not really that environment. It looks more like 95 or 98 or some combination of the two. So that suggests us small caps may be a neutral. That's where we're at. We are neutral small, and we don't think this is the time to think about an upgrade. In fact, if you're going to move one way or the other on small caps, we'd err toward the cautious side, frankly. But neutral feels right because they're so cheap, especially high quality small caps. You're hearing that from a lot of strategists out there.
Jeff, I'd like to add something here too, is I would keep my eye on how the financials, large cap and mid cap financials, respond to whatever the Fed says. We've got Fed speakers this week, for example.
Regional banks love rate cuts.
And the reason is that small caps are very sensitive to the small banks, small and mid-sized banks within the space, and they tend to follow their larger brethren in determining the health of the bank or the financial sector.
Yeah, that's a great point. Regional banks still want lower rates.
Yeah.
It's not March 2023 during Silicon Valley Bank, but a little bit of a bump up in the value of bond portfolios for the regional banks would be positively by the market. So we'll be watching rates closely as it pertains to that chunk of the small cap index as well. I know financials are in the high teens as a percent of the Russell 2. I think banks are close to 10%. So pretty big weight. That really matters. So thanks for that, Quincy. Last thing's earnings. I have our latest earnings dashboard up, but I just wanted to get your thoughts on NVIDIA and maybe what we've heard from the retailers.
Well, the retailers, I love this because you can't make this up. Because last week we had the discounters, and boy, have they discounted. And before that, we heard from Walmart. They had been discounting as well. And the thing that they told us was, that is to say Walmart, was that the folks who were going in there during the worst part of the inflation spiral were those, that they never expected. And those folks with household wealth of $100,000 or more. They get this information from the credit cards. And they said those folks are still going into Walmart, even though, prices in food have come down a bit, not great, but come down a bit. They're still shopping there. The other thing is that Target, right? We typically go from Walmart to Target, but Target had a problem, but they went in and they started cutting prices across the board. Now their food section is quite small compared with Walmart, but they went from the food to other essentials, and they went straight to apparel and also the home goods, cutting. And they saw traffic picking up markedly, including online. So that helped them very much. And then you had TJX. The brands there are Home Goods, it's TJX and Marshalls. And they said full year outlook, excellent. So what this tells you again and again and again is that the US consumer, careful, discerning, and really, really making sure that they get value for their purchases. And they are very focused right now on value, but also for essentials. When we looked at the retail numbers that came out, and remember that retail number was higher than expectations, and it sort of had the market take a sigh of relief that consumers were spending. But one thing I noticed, Jeff, is that we are spending more on things that we really need. And the fun things, we're kind of waiting, and we're waiting for discounts. How about travel? We heard from the airlines, they have to put these extra seats up for sale. And I think that US consumers are actually taking advantage of that, particularly at the end of the summer and that last bit of travel before Labor Day. The other thing I'm paying attention to with all of this is the credit cards, because they give us a very important story. And whether I'm talking about Visa or MasterCard, we are hearing from them that we are slowing down our spending. Take a look at their share prices. The only thing we haven't heard is whether or not business spending is pulling back, and that we will hear from American Express if they will have a view on it when they finally for the next quarter tell us how they're doing. But we are seeing the pressure on the credit card companies, and we have to be very respectful of that, because they tell a very important story about not just where we were, where we are, but where they believe we're headed.
Yeah, good point there. It's also too early to start talking about how the election is affecting people's spending
Yes,
or
yes.
corporate investment plans or any of that. I mean, I guess the biggest political issue for markets is going to be the tax cuts that expire in 2025, but there'll be plenty of time to plan for that after the election. So right now, probably not going to affect retailers too much. I'll also say that the Bookbinder family certainly chipped in and did some back to school shopping over the last few days. We were looking for value too, Quincy. So actually, I think my daughters both went to TJX without me. They went with mom, but certainly I've spent some time at some of these retailers looking for value, and the prices actually aren't bad. I think I've seen evidence of some price cuts at some of the teen retailers. So a pretty good overall, pretty good back to school season, I would say, based on what I've heard from retailers. And I'd say the same thing about earnings season overall. I mean, of course, you can't really evaluate earnings season without NVIDIA, but to date, tech has been a winner, certainly growing earnings 20%. And then overall, the estimates have held up quite well. The growth rates have been quite strong. We've seen some areas like healthcare reverse recent earnings declines and turn those into nice earnings gains. We've seen broadening out, right? The 493, as people like to call it, grew earnings mid-single digits. That's the first time we've seen that in a while. But of course, the big techs are doing their part too. So really positive messages, I think, coming out of earnings season. It hasn't been enough to drive a breakout in the S&P 500, but it certainly gives markets a chance at making that next leg higher. We'll just have to wait and see what happens if the S&P gets to this all-time high and tests that resistance. So that's that. I think we kind of covered the week ahead, Quincy. So maybe we'll just fly through this. But here is the economic counter. I starred durable goods and consumer confidence. Durable goods we got this morning. The numbers were fine, but you had this big jump in transportation orders, which is planes, right? And that makes the transportation orders really bumpy. Otherwise, I don't think that was that meaningful. Any thoughts on that or consumer confidence? I'm just showing the first 3 days of the week here.
It's amazing about consumer confidence. I mean, it continues to come in lower, yet consumers are spending, but there is a drain in consumer enthusiasm. And again, how do you manage that with 4.3% unemployment, which in and of itself is still good? I look at the New York Fed survey that came out, and it said that Americans are worried about the stability of their jobs, and even more worried about losing a job and not finding another job. And they are also complaining about their wages not keeping up with their perception of inflation. That was a powerful survey. Needless to say, we tend to look at data rather than just surveys. But I thought that one was extremely interesting because it also, Jeff, ties in why we are looking for value, why the discounters are doing so well.
Yeah, I think the cumulative effects of inflation, you compare prices to 2019. I
Exactly.
think that's still in the back of people's minds. They're anchoring to what egg prices cost 5 years ago,
Yes.
or milk or other things at the grocery store, which is why the Harris campaign is talking about price controls and all of that.
She gave that up. I think she gave that up.
He's given that up. Well,
I think so. I think she got hammered.
well,
Like
she
people like,
should. I
no,
mean,
no. Yeah,
it's not even a partisan comment to say that that's not good policy. I mean, we've seen it over and over again. Fixing prices certainly hasn't worked for
yeah.
any meaningful period of time, but nonetheless, inflation is still an issue in people's minds. And then just political divisiveness is probably weighing on these consumer sentiment indexes as well, something we've certainly seen a lot more of in recent years. We'll see what happens to these things as we get past the election. But yeah, people are spending, but they talk like they don't feel very good about things. So of course, later in the week is the biggie, the core PCE. The GDP report is the second revision, right? So it's probably not going to move much off of the first, but it's just a convenient time for us to talk about this economy continues to grow. Recession is not imminent. And clearly with the market near all-time highs, it's responding to that. Anything to add there, Quincy, about either those points or others here for the last 2 days this week? My gosh, there's so much data this week.
There's so much data, yeah, but the expectations are that we will probably see the second revision to second quarter to stay at about 2.8%.
Right.
But for this quarter, the one we are in, we are looking at below 2%. Not dramatically lower, but certainly below 2%, which, by the way, can actually help the economy simply because, again, it's cooling down. But you don't want collapsing, you just want cooling down. And right now that might be extremely helpful. But again, all eyes on whether or not we're in a growth scare. Pay attention, I think, for everybody, is when we see the reports coming out, look at where the yields go, look at where the 2-year is, look at where the 10-year. Yes, we want it to ease, but we don't want it to collapse, because if it just starts jumping off, we know that the response is that there's a growth scare. Remember, we saw that a couple of weeks ago, and it scared the daylights out of the market.
That's right. That was the match that lit the carry trade kindling.
Yes, exactly. I like that. That's very good. I'm going to use that. I'm stealing
Yeah,
that.
that's kind of original.
I love it. I'm going to be using it. Yeah. I'll say it's mine if you don't mind.
You can take credit for it.
Thank
So
you.
thanks, Quincy, for all that. That's a really good insight. and the carry trade is still there. But if inflation continues to come down, the market can continue to function calmly. We won't have a spike in rates. We won't have a collapse in the yen.
Yeah.
Most likely. And I mean, perhaps we're cautious on this market overall, but perhaps we can just keep going higher. We'll have to see. So we'll wrap there. Thanks, Quincy, for joining.
Thanks. Thank you so much.
Really appreciate it. Thanks all of you for listening to another edition of LPL Market Signals. We will be back with you next week for another edition. Have a great week, everybody. We'll see you then. Take care.